In front of you is the loan estimate, a sample of a loan estimate. This is all made up just for purposes of this conversation, but it will answer the questions and concerns many of you have when you apply for a loan. So the first page is just general terms: name of the person, date issued, property address, sales price if it's a purchase transaction. Then on this side you can see it's something called loan terms. As you can see, this is a 30. I'm going to make it a little bit bigger. This is a 30-year rate, and it's fixed, as you can see, okay? And it's a purchase transaction, conventional. There is a loan number here. Rate lock, it says no. At this point, the rate is not locked. When it turns to yes, you will get a revised form that will be sent to you with the terms of the rate lock. Also, loan estimate will be with the rate lock. Now, the loan amount is here, $400,000. The rate that you discussed, hopefully, the payment. Payment is a function of the rate, loan amount, and your loan term, which is 30 years in this case, as I said earlier. We're moving on. This loan has no prepayment penalty, okay, and no balloon. Sometimes loans have it, so hopefully this is what you're going to get, and if not, hopefully also that it was discussed with your mortgage professional. Next is right here. Your mortgage payment is not necessarily going to be just this. Sometimes it will be, a larger number, because that would include what's called taxes and insurance, or in one word, escrows. So that will go to the bank. That will also go to the bank initially, but they just collect it to pay your county or city for taxes and your insurance company to protect your home as a homeowner's insurance. It's right here. And here it says yes in escrow, meaning the bank is collecting this $820,000. Why does it say yes? Because sometimes it can say no. In that case, you will just pay the mortgage, and taxes and insurance you'll pay directly to your tax authority and the insurance company. And here these are the totals. We're going to come back to them. Let's look at page 2. That's where the most fun actually is located. I'm going to make it a little, I'm going to zoom out a little bit so you can first see the page. That's how it looks. And then let me just zoom in to where we were. Page 2 is broken down into sections. The first section is usually the broker fees and the bank underwriting fee. And then the total is here. The total is always, you see, it's like, in a bolded font. And 4,700 plus 1,250 is 5,950. Again, this is just an example. This is your loan origination fee, usually your broker fee. However, this one is related to the item here on the bottom with item J, what's called lender credit. You see, in this case, lender credit is $1,800. So your broker fee is actually this minus the credit that the bank is giving you towards the closing cost. So you only will pay the net, which in this case a little bit less than $3,000. 4,700 minus 1,812. Okay, we're moving on. Then there's various fees here: appraisal fees, credit report fees right here. This is appraisal fee. These are small bank fees. Again, the total is here. The next section has to do with title insurance usually, and the bank, the bank will send an attorney, or a title company will send a representative for closing. This is their fees. Again, all the fees are, made up for this example. There's a title search over here, so that completes section C. And then section D is nothing. It's just a combination of C, B, and A. Okay, you'll never find anything in section D except for the total. Then the other costs are here. This is transfer taxes. I want to spend a little bit of time here because this is a confusion people have all the time. This is just called transfer tax. In fact, in places like New York and other places where there is what's called stamp tax or mortgage tax, it is all lumped together. So mortgage tax, sometimes even mansion tax in New York, if property is more than $1 million, there's an additional tax. And the real transfer tax, if the buyer is paying for it, is here. Okay, what's really important to mention here is By the way, in this example, it's 0. It's never usually 0. It's a number. This is again just an example. You will have a few $100s here as well. What's notable here in this whole discussion is that there is a rule. If the bank underestimate a certain fees, then they have to pay the difference. Well, let me give you an example. Let's say your transfer tax is not $6,000, okay, and in fact it's going to be, in this example, $7,200, okay. The bank made a mistake and they underestimated. Guess what? They have to pay the difference. So what they started doing, they started unfortunately overestimating the fees. Because if they told you it's going to be 6 and and it turns out to be 5,000 or anything less than 6, that's okay. You will pay less. But if it's more, then they're on the hook. That's why these estimates look so high, but in fact in closing they get fixed. Okay. We are, by the way, the description of transfer taxes, you will find more of it in the description to this video, so please search there. Now, next section is called prepaids. Prepaids is something that you pay at closing, not really your closing cost, but you pay at closing for taxes. Then this one is very interesting. This is for 6 days. This is the mortgage interest. Usually, if you close 6 days before the end of the month, this is when it shows up for the remaining 6 days of the month, and then it starts on the calendar month basis. That's why they always adjust it to the end of the month. And then property taxes. If the county charges you $2,100 for a quarter, then the bank will collect this money. Title company will collect this money on bank's behalf and will pay this to your county. If you think about this, it's really not the closing cost, because even if you don't take the mortgage, very often you will have to pay taxes up front. If you think about this, this is really not the closing cost, because taxes and insurance for your property will have to be paid anyway, regardless of your mortgage or not. If you choose not to get the insurance because you're not taking a mortgage, that's a different story, but they're very, very rare. And then this is a very interesting section: initial payment into escrow account. So what that is, remember over here I told you that the estimated escrow $820, taxes and insurance. Well, the bank creates a cushion for itself, so they have some money to operate in case they need to make the payment. This is your bank account from which the taxes and insurance will be paid, but it can never be zero. It usually has a cushion of 2 months, sometimes 3 months over here. You see, they have the money, so they can have enough for next month, for next payment. And that summarizes it. If you total it all up, in this case, the closing cost was $21,000. Now, what is this $121? That is this closing cost plus the down payment. And the down payment is the difference between the sales price and the loan amount. So $100,000 down payment, as you can see, plus the $21,000 in closing cost. You need to have $121,000 for this transaction.